In this video, we're going to study distressed samples and the drivers of distressed samples. A sample is in distress if in the next calendar year, the total losses in that calendar year achieve, say, the 99.5 percentile. This could be, if you're looking at multiple lines of business, which we are here in the first instance, 6 lines of business. So let's run the model for the 6 lines. And let's do a forecast for the 6 lines using our conservative assumption same. Now, each calendar year in aggregate has a distribution. That's the mean and standard deviation, mean and standard deviation. Let's now just simulate from all the lines of business to find the distribution of the aggregate, just as a quick example. So we're doing millions of simulations here. I just want to know what is the distribution of the calendar year total losses for 2010. That's the next calendar year, 2010. Let's find out what the 99.5 percentile is approximately. So we go and quantiles value at risk, and let's find out what for the next calendar year, 2010, what is the actual 99.5 percentile. So 99.5%, we only did 10,000 simulations, so this is approximate. We're looking at around, say, 294 million. Okay, you've got about 294 million. So the question now arises, if we look at the forecast table again, it's around 294 million. So what kind of samples by, say, accident year, what are the values here in each one of these cells, in each one of these accident years for 2010, and also how do they differ by line of business so that in total we achieve around the 290, is it 290? The 290, 292, 293 say. So what we do now is, let me just close this window. We're going to go to AS2 module, 1-year risk horizon. We're going to redistribute surplus across LRBs. In other words, if in a particular calendar year for a particular LRB, the loss is actually less than the mean, that surplus or difference can be used to pay for losses in another line of business where the loss actually exceeds the mean. And also we're going to use the same concept of fungibility going forward by calendar year. So if, in calendar year plus calendar year 2, 3, and so on, in a particular calendar year, the loss itself is less than the mean, that can be used to pay for losses in future calendar years. Well, let me do the simulation. We're actually going to be doing 492 simulations that are correlated for each one of these lines of business. And for each line of business, what we've got is forecasting 410 cells. And we've got 6 lines. And we're going to do it 100,000 times for the unconditional distribution. So we can cut by calendar year, so we can calculate all the unconditional VARs. Then we're going to find the conditional distributions of calendar years 2011 onwards, assuming that 2010 is in distress. So we're going to do another 100,000. So this means in total 492,000 simulations from correlated log normals. That takes about 5 minutes. So now let's look at the Solvency II grid again. We've got our barrels under standard, discount, and we've got the unconditional VARs, the conditional VARs, and so on. Let's look at the stress sample path. Okay. I don't know that these tables are really all that useful, but for instance, let's look at sample. This is sample 1. Switch to sample 2. So in sample 2, the observations in the aggregate. So that's what I mean by aggregate. So let's look at let's tile this on its own. Let's look at the forecast table also, and let's look at the two together. Let's switch to aggregate. Now we're saying that in 1990, in aggregate, which is right at the top here, might have been better starting at the bottom. Oops, got to switch a bit to the left. 1990. What we observed in this particular cell, development year 20, we observed at 192. Well, the fact there's no number below it, if it was above the mean, that observation is obviously less than the mean. It'll tell us how many standard deviations above the mean. In aggregate, we observed 163 in that cell and so on. But in 1994, in aggregate, this is for a distress sample, we observed, the mean is 382, but we observed 695, which is 2.61 standard deviations and so on. So if you go down in aggregate, all of a sudden when you get to the more recent accident years, you can see you've got 2.49 standard deviations, 2.8. So in aggregate, we observed some very large values around here. So for instance, at 209, we observed 167, what is it? It's million, 167 million, which was 2.49 standard deviations. Here, well, it's 293. 293 million is around the 99.5 percentile, and so on. But what were the observations for LRB1? Well, we also have this column for LRB1. What were the observations in this line? So starting off here, we've got, in aggregate, we observed 63, where the mean is actually 50, and then we observed 48 for 2009, and so on. This is a sample which is in a distress situation where the aggregate is around 293 million. Then I can look at another sample, sample 3. If I look at sample 3, we're still around 292, 293 million in a narrow band of 100 observations, and so on. But this is also graphed for you. So let's look at the aggregate now. And so these are the graphs. For instance, sample number 3, you can see the blue line. And wow, look, I mean, this was really distressed in 1994. Where does that come from? That was a distressed sample where you got this huge value in 1994. It must have been obviously caused by process variability. If a distress situation is caused by some parameter like a future calendar year trend becoming very high above the mean, then a lot of the values in each accident year will be much higher than the mean. But that's not the case in this situation. This is much higher than the mean. It's a very extreme observation that occurred in 1994, but you can see in some other years that sample path along the accident years, the values are actually less than the mean. Now, that's in the aggregate, and if you look at the aggregate, this in terms of number of standard deviations. If you look at it in terms of really what are the values, well, you know, you've got to reach around, in aggregate, you've got to reach around the 50 now these are mean deviations. So the mean deviations, they actually tell you, for instance, that to be in distress in the aggregate, you're around 50 million, for most of the samples, you're around $50 million away from the mean. So if I go back to the forecast table, yeah, I mean, the 99.5 percentile is around 293 million, so you're about 50 million away. All right, now let's change back to standard deviations. If I now go to LRB1, it's really a pity that we've got this extreme observation and we don't get a good handle on what's going on here. So why don't I change the scale? It's a pity about this is really an extreme outlier here. I mean, let's put the whole calendar year in distress. Let's edit the graph, change the scale, say to y-axis, and why don't we change the scale to about 6, just to show you what it looks like. So now you can see that yeah, that really, in aggregate, the years that are really in distress, total being in distress, is 2009, 2008, 2007, and then the other years, I don't know, they appear a little bit more random. So, I mean, they're still on the average above zero. You can see this sort of a valley, the blue valley. So, you know, it's skewed, but for most of the distress is being driven by the observations in the last few accident years. And occasionally, of course, you had that huge number in 1994. You do have some large numbers in other other accident years, but by and large, most of it, in most of the distress samples, it's actually coming from the more recent years. I mean, if I look at this sample, well, of course, a lot is coming out of 1999. If I look at this particular sample, then a lot of it is also coming out of 1996. The distress is caused by 1996, and to some large degree here in this example, 2004. Now, if you look at LRB1, you'll find that, except for these very few outliers, let's change the scale here also, and y-axis, let's change it to 6A, 7. Again, you could see there's not much distress going on. There's a bit of distress in 2009, but by and large, you'll saw that very little distress from LRB1. I actually should go to LRB3, which is the largest line of business, and you can see that most of the distress is coming from that line. If we go to our forecast summary and we look at LRB comparisons, you can see that LRB3, even though it actually has the smaller CV, but it's the largest proportion of the business in terms of mean reserves. So you can see that really drives the distress. Large numbers in LRB3 are actually large. If you go to LRB4, which is the most volatile, well, you know, it's obviously skewed. It's a skewed distribution. The samples that contribute to the distress situation in the aggregate, you can see they're skewed. Every accident year's got skewed observations. More observations are above the mean than less than the mean. LRB4 is the most volatile line of business in terms, and it's the most skewed. If I look at LRB5, it actually does very little in terms of contributing to the distress, and LRB6. So you can look at the summary. If we look at distress samples box plots, and that really tells you in terms of dollar values, most of the distress is coming from LRB3 in terms of dollar values. If we go back to our distress sample path and now change the y-axis, the vertical axis, to the number of the mean deviation, or actually it should be called the deviation from the mean, if you can see that if we go to the aggregate, oops, what happens here? Mean deviations from the mean. Maybe because I changed the scale. It must have changed for every graph. So let me reset the scale. Scale, y-axis, reset the y-axis. Okay, and now we click on OK. All right, so the mean, the deviations from the mean for the aggregate is around 50 million. LRB4, well, you can see it's very small dollar values because LRB4 is a small line of business. LRB1, again, we've got a bit of a problem with the scale, but I'll reset it. Sorry about that. It shouldn't have changed the scale for once. I've reset it for one graph. You kind of expect it to also reset it for all the other graphs, but it didn't do that. That's going to be fixed. The system hasn't been released yet. Okay, so you can see with LRB1, which is the second largest line, you're looking at around 40 million, 30 million, 25 million sort of contribution. But if we look at it in terms of box plots for the contribution in terms of losses above the mean to a distress situation, let's see what we've got. We've got the distress box plots, and you can see that LRB3 about 80% of the time contributes to a distressed situation. There is a range here. It's a box plot. And LRB1 sort of about the other 20%. And the other lines of business really are kind of insignificant in terms of contributing to distress because the values, the amount of losses, the solvable losses are pretty small. Okay, the next issue I want to look at, and I'll only do it for LRB4, is that the contribution, if you like, of parameter uncertainty, of volatility to a distressed situation. So if I go to LRB4, which is the most volatile line, I run the model. And now let me save the model parameters. Let's call it good. Let's now load model parameters. Which is also good. You notice that all the standard deviation, all the uncertainties of volatilities in the parameters are set to 0. If I now go and do a forecast and go to future parameters, make the process volatility or variance, say close to 0, so hardly any. So the only volatility going forward is based on the IOTA parameter, calendar year parameter. Let's make the standard deviation, say, 9.099%. We don't have to save that scenario. Let's do OK. So when you look at the forecast table, what's happening now is all these standard deviations are just driven by that parameter. If you go to forecast summary, let's look at the forecast settings, and we find that the future variance has basically been set to 0. The future IOTA, that's the only volatility going forward. In other words, we're assuming that the true parameter is a random number from a normal distribution with mean 14% and standard deviation 9%. So one realization could be 28%, another realization could be 4%. That's going to drive the volatility going forward. In fact, it's the only driver in this particular example. So now if I do the simulations and recalculate the solvency one-year risk horizon statistics and look at a distress sample, the distress sample is only caused by this parameter volatility or uncertainty, which is part of the model. So if we look at solvency grid, the stress sample path, well, you can see, like if you look at the first sample, the observation 39, which is 2.67 standard deviations from the mean, 3 standard deviation, 2.8, and so on. Every value is larger than the mean in that sample. Let's take another sample, sample label 12, again. So if you look at the chart, you can see that there's only a particular very small range of IOTA parameters, of calendar year parameters going forward. This parameter here, let's look at it again. It's got to be at a particular level, I don't know, maybe 28, 29, 30% for the next calendar year to be distressed. But if the next calendar year is in distress, all the values in the calendar year are very high. You can see that all the values are very high. And any sample, they're very high. Let's look at the chart itself. They're always very high. And we're looking at over 2.6, 2.7, 2.8 standard deviations from the mean in each accident year in order for that particular calendar year to be distressed. And this is only driven by parameter volatility because we set the process volatility to essentially 0. Now, in the real case scenario where we looked at the multiple lines of business, if we go back there, if we look there, and we looked at multiple lines of business, for each line of business we have a model. Each one has parameter uncertainties and explicit process volatility for each line of business. So now the drivers of the aggregate being in distress are specific lines, like LRB4 was a strong driver, so LRB3 because that was the largest. The volatility or process volatility in that particular line, and also the parameter uncertainty or volatility going forward in the particular line. So over there we've got the 3 drivers. Whereas we only looked at LRB4 on its own, we were just trying to separate out the process the parameter volatility contributing to the distress situation. So let's go back to this case, and you might remember that if we look at our table here, if we go back to the summary, we did have a lot of diversification of the market value margin, if you like, which means the technical provisions, and we also have a lot of diversification of the SCR amongst the 6 lines of business. And in fact, you might also remember that the total capital at inception is around the same as the undiscounted reserves. So if you look at the difference between the undiscounted reserves and the discounted at 4%, that was our risk-free rate. Let's look at our settings. We're using risk-free rate of 4%. The difference 609 and 697, which is about just under 90 million, is equal to the market value margin plus the SCR. So really, if a company was using an internal ICFRS Plus model for these 6 LRBs, as a result of having risk diversification credit, these lines are essentially non-correlated. Let's find out what the correlations are in the reserve distributions. Again, LRB comparisons, summary by data sets, correlations. Well, the LRB1, LRB2, the correlation is very small, all the other correlations are 0. You get a lot of risk diversification credit, and therefore the total capital at inception is about the same as the undiscounted reserves. Let's look at the charts. The total capital at inception is 691 million, and it's about the same as the undiscounted reserves. Thank you.